Let's begin with the market. And what a strong quarter it's been on Wall Street. The Dow's up 4%, the S&P 500 soaring to 10%. The NASDAQ is higher by 17%, tracking for its best quarterly gain in 5 years. So technology, communication services, industrials, discretionary are among the top performing sectors on the S&P 500 quarter to date. And joining us now with key themes to watch in the second half is Richard Bernstein, Advisors CEO, Richard Bernstein, and Citi US equity strategist Scott Chronert. I mean, this is an all-star market panel to have this conversation. So welcome to you both, gentlemen. Richard, I'll kick it off with you. We're at record highs for the S&P and the NASDAQ. Stocks continue to climb the wall of worry. What's next?
So, Morgan, good afternoon. I think, stocks are looking at a situation where it looks like we're going to have pretty significant fiscal stimulus. And I think more than that, the markets are still banking on the Fed being able to cut rates. So if you've got positive fiscal policy and positive monetary policy, it's hard to see why stocks would go down. However, that being said, what's I think more confusing, and everybody should be kind of scratching their heads a little bit, is why, with all this broad policy in the economy, are we seeing such a narrow stock market? That doesn't seem to make an awful lot of sense. We should be seeing, if these policies are actually going to work, we should see a much broader stock market, meaning more companies are going to benefit from it.
Why do you think it is so narrow? And we talk about big cap, Richard, we talk about big cap dominance. Has that sort of reasserted itself? And if so, why? Why now?
So, Morgan, I would correct one thing. I don't think it's even large cap. I think it's about 10 or 15 or 20 companies. When you mentioned before the NASDAQ 100, the NASDAQ, the S&P, but not things like the Russell 2000 and the Dow Transports, it's the same 10 or 15 or 20 companies that are dominating the marketplace. I personally think that reflects the speculative fervor in the stock market. There are way more than 10 or 15 or 20 growth stories. It's just that nobody cares. They only want to trade, keyword trade, 10 or 15 or 20 companies. I think if you're an investor, it doesn't get much better than this because nobody cares about all these attractive investments as opposed to simple trading.
Scott, what do you think? You used the word euphoria in your note.
Yeah, Morgan, I think we're approaching euphoria in our classic sentiment indicators. But, I take a couple of points of issue with Richard's comments. I think what we're looking at here is really a follow the growth mantra to this market. We walked to the edge of the cliff fundamentally with DeepSeek earlier in the year, and then the Liberation Day tariffs. And since then, we've been walking back from concerns on both. You've begun to see the AI tailwinds kick in, if not accelerate. But what's happening here is that the Mag 7 are showing a perpetual earnings growth dynamic into 2026, which is actually beginning to increase now from where it was. The other 493 searching for bottom still, but what we're seeing here is a very clear differentiation between those companies where there's an upward bias to numbers as we go into the back half of this year, begin to look ahead to 26, and we think that's going to be your ongoing driver here. So what we need in terms of the Fed discussion, the fiscal narrative, is that we need to see some sense of a soft landing continue to show through. But ultimately, we need to begin to see an earnings revision dynamic to the positive for that part of the market that's more traditionally interest rate sensitive.
And of course, we start to get earnings again in full throttle in about 2 weeks, give or take. So, Scott, where do you put money to work right now then, if this is how you see the next 6 months, year playing out here? How do you position yourself for the second half?
Well, we just put out our quarterly sector call over the weekend, and let's say that we went all in on growth going into Q2, and we're digging in on that call. We still like the tech sector. We like communication services, both media and the telecom component, interestingly. And then we're beginning to broaden beyond that. From a cyclical perspective, we've been on financials via the banks for the better part of a year. Still like that. And we're starting to allow, as I mentioned earlier, for some room for those areas of the market that have a bit more of an interest rate sensitive bias to it to kick in. We went overweight utilities as an example of that. So where we're going with this is that wherever the growth revisions are taking us, and we think that's going to be this AI and related construct, that's where we want to continue to focus for now.